So real estate investors have slowed down their property purchases, especially in the Sun Belt region and the rest of the country. This is a concern because typically what I always see is the feet in the street, the mom and pop investors, even the large REITs and hedge funds, they pull back their capital expenditures when markets are going to change and they believe there's risk happening in the near future. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate. Today's the 17th of November. It's the last day before the Thanksgiving week. Hope everyone's doing well. Hope everyone's got great plans for next week. I will be traveling, unfortunately, for not a great reason, but that's the way life goes sometimes. Anyway, just want to get this out there right now because it might be difficult for me to do videos next week, but I do appreciate the uptick in views, so I'm glad you guys are back to watching. That sounds good. This is what's happening in the marketplace right now. So investor home purchases are down over 40% in Sunbelt pandemic boom towns. And also we look at nationwide, 30% year over year, lowest third quarter level in 7 years. Why? Rising mortgage rates, high home prices, lackluster rental market made investing less attractive. Now, one of the things that I do, or when I work with investors to do things myself, is we look down the road. So if you're going to buy a property and say you want to fix and flip it, well, guess what? You have to envision what's the market going to look like 6 months on average down the road. If you think about it, you buy your property today. It's going to take a couple months to get it rehabbed. Then you're going to list it. Then you're going to go under contract. And it's going to be a month or two to close it. So we're talking, about a 6 month, on average. So investors go, where are things going to be at, and what risks am I going to face? So everyone's kind of holding the cards close to their vest because they know there's going to be problems down the road. This is a report supplied by Redfin about this. So if you want to check it out, just go to Redfin. Obviously, you can see that the investor purchases are down almost to where they were during the pandemic. Okay, so very interesting how everyone's kind of scared right now, and it does make a lot of sense. However, there are certain metros that are really getting beaten up with respect to investor purchases. And why does this make a difference? Well, if you take a look at it, it's actually good for retail buyers because less investor purchases means less competition for properties and less cash buyers, where that can be leverage against retail buyers that have mortgages or require mortgages and things like that. So Atlanta area saw the steepest decline, almost 50%. With respect to lack of investor purchases, followed by Charlotte, North Carolina, Jacksonville, Florida, Phoenix, Vegas, Orlando, and Tampa. So these are locations that typically get a lot of investor activity for a number of different reasons. Again, it's funny because this is the top ones are in the Sun Belt. And obviously, that's where a lot of activity is. So basically, they took a look at, when we refer to a record, the record dates back to the first quarter of 2000. So, it's been 20 years now where they've been doing the analysis. And, these are record declines in investor purchases. So that's your top 7 right there. Obviously, you can take a look at, the national growth. So it's down 30% pretty much. Timing makes sense, right? We had the slowdown during the COVID pandemic. Why? Because people just weren't out there looking at property, so purchases, suffered. Clearly, we had the 40%, 39%, annual price increases after the pandemic, right after, and then obviously we've come back to life with investors going, wait a second, we can't pay these, prices for properties. But again, if you're buying property to cash flow or to do a fix and flip type project, rehab and resell, it's cost of money to hold, cost of money, cost of acquisition, holding costs, and also, rehab dollars, right? The cost for all the materials and labor. So it's a lot of money that goes out. And when interest rate goes up, hard money lending goes up. Other type of lending goes up as well too, short-term bridge loans, the whole bit. So it makes an impact to your bottom line. That's why investors are going to pull back until they see some changes in the marketplace. So, by the way, guys, because we're approaching the Thanksgiving week, this is what I got on the go here. We're ready to launch this now. It's going to be a great, great program. So if you want more information, please reach out to me. I can talk to you about this, but I'll be offering some significant discounts clearly over the Thanksgiving break here. All the things that are on this list I'm actually doing. I'm doing personally, or I'm working with other joint venture partners or other investors, etc. These, you wouldn't believe what we're looking at right now, how we can, take advantage of this market. And for people who say, hey, the market's too high, it's too high, it's too high. Well, guess what? That's on price point. But on the flip side, we have a whole other economy people are hurting very badly in the economy, and they need to liquidate. What happens in a poor economy? They liquidate toys, extra cars, jet skis, boats, RVs, whatever. So people are giving stuff away to accumulate cash because they need the cash. And we're seeing a lot of distressed properties out there, a lot of financially distressed properties. People are stuck and they need to sell. So a lot of seller financing or subject to available. We're just seeing a lot of foreclosures pop up now too. So it's actually happening. You're not going to hear about it in the mainstream media, of course, here. So people who comment, and there's only a couple of you guys, I understand that say, hey, I've been talking about this for how many years now? Well, you know what? If you've actually been following the marketplace, yeah, the market's manipulated and things are high value-wise, but there is so much distress happening behind the scenes that doesn't come to the surface. You got to get it, but also it doesn't get talked about, in the mainstream media. So that's why that's why they are what they are. All right. So investors bought $36 billion worth of homes, down 20% year over year. So that's $36 billion is a lot of homes. That's even down 20%. All right. But and the typical, home purchase by investors cost $475, up slightly from $449 a year earlier. So home prices have ticked up. So home prices ticked up and interest rates go up. That just cuts into your margin, makes your risk, risk requirements. You got to look at those a little bit tighter here. It's the way it is. We don't expect investors to drive back into the market in a big way soon. Said Redfin senior economist. Borrowing costs are unlikely to fall significantly in the near future. While home prices may soften a bit, they probably won't cool enough to bring back a critical mass of investors. That's right. So people are doing high-level investing, buying at maybe auctions, buying off MLS, this and that, the whole bit. But what we do is we focus on a lot of behind-the-scenes stuff where we're getting phenomenal deals. We're able to do things that other people just can't do. So that's why you want to reach out to me. So investors purchase roughly 1 of every 6 homes that's sold. So obviously that's what they're doing, but the market share is going down, as you can see here. Investors listed fewer homes, but those who did sell still reap gains. So this is the thing. So as much as it might cost more, if you have a great property, good location, nice rehab, whatever you're trying to do, the numbers were up. So basically, investors, I guess just typical homes sold by investor went for $179,000 or 61% more than they bought it for. That's up from $144,000 or 44.6% a year earlier in September. Why this is important, is because, again, they're not making that money because I'm sure that there's rehab costs, acquisition costs, holding costs, selling costs, but at least the gross margin is increasing. So prices are going up in some locations, or the demand for nicer homes is there. So the investors, even though there's less going on, the ones that are involved are making more money. Typically when this happens, it's usually the pros. So people who do have, do a number of properties per month, who have crews and have great buying strategies for buying materials and things like that. Those are the people that are actually doing really well in the marketplace because they're experienced, they know what they're doing, and they've got some volume buying power. But you can just see how it's interesting. So they're selling homes for more, but they're selling less of it. And we're still running into, potentially I can tell you it's a risk scenario, because all the people I deal with are like, listen, we're not going to overpay, and we're really holding back now. Their sort of cash purchase price has, their discounts that they expect are increasing because they don't want to be stuck with the risk at the end. All right. Interesting. Basically, we see that investors who bought up all the Airbnbs are selling. Some are institutional investors and some are mom and pop investors who got in over their heads. This is an important part. So obviously, Airbnb was the craze for the past few years, the short-term rental market. So people were going, well, I can buy it at top of the market. I can buy it at, with a higher interest rate because my pro forma shows that, I'm going to make, X number of thousands of dollars a month. So in a way, it didn't really matter what your rates were and what your price points were because you still had the ability to make a lot of money. Well, what's changed is that now we're seeing a lot less short-term rental activity. So people are now going, oh my goodness, I have a high mortgage rate, high interest, big payment. My, bookings are down significantly, and I'm not able to either make money or cover the mortgage. So this is I call this kind of like this extra sort of buying, like people were buying these things or doing arbitrage, right? Leasing or renting the property on a monthly basis from an owner, paying a premium for that and doing their own Airbnb afterwards. So this is where things kind of play out. So, but again, so what shows us that what the market tells us is that, well, if investors are not buying, there's a problem right now, and there's more problems on the way. If people like these non-pos or institutional investors that were doing Airbnb, if they're not only not buying, okay, but they're now selling. They know that the fun is over, and they either need to liquidate to get their money out, or it's not making sense anymore, and just to cover their losses. So that's the situation. So my perspective, because I've seen this in the last housing crisis, and please understand, I participated in the last housing crisis from 2006. I was doing real estate in 2003 and 4, so I saw the quick growth, the crash, the whole bit. So I've got good experience in watching what has happened. And when you go through a complete cycle, the signs are there. So yeah, people are now, this is what was happening before the last housing crash. People were trying to sell, and suddenly things were going in the marketplace and stuff wasn't moving. And then, oh my goodness, then we had short sales and foreclosures. So we're kind of in that spot right now. There's a lot of problems going on, and it's not subprime mortgages. All right, subprime mortgages were the start of the last housing crisis. We now have unemployment issues, high mortgage rate issues. We have personal economy issues. That's what's going on. So it really is, it's a situation where people can't afford this stuff anymore, and maybe they overbought or overpaid, and now things have changed in their personal economies or finances, and now they can't make ends meet anymore. This is what's happening right now. So unlike the last housing crisis or the last financial crisis where we started with housing, it's like this time around we've had all the issues and we're going to end with the housing crash. That's how I kind of see it here, guys. So again, just a quick here about per tier investor market share. So clearly the investors are buying more of the lower end homes. Why? Because there's more margin in it, more fix and flip, less risk. On the other side though too, on the luxury side, believe it or not, you can do pretty well. But again, you can see those purchases typically drop when things tighten up in the marketplace. So, and folks, once again, I thank you for your everybody watching the video. So if you're not a subscriber, if you love the information I provide, if you could smash that subscribe button, that would really be appreciated. And if you think you're a subscriber, if you could do me a favor, resubscribe, hit the bell notification, because I lose subs every day. I actually, the past couple of videos, saw some uptick, which was very nice. So I appreciate everybody. Hopefully we'll plug some holes here and see what's happening behind the scenes. But if you could subscribe, that'd be really appreciated. All right, as we move forward, this is some high-level highlights for investor activity. So again, the figures below cover the third quarter of 2023. Where investor purchases decreased the most, well, obviously the biggest decreases were Atlanta, Charlotte, and Jacksonville, like almost 50%. And then we had the other sevens like Orlando and Tampa and a few other locations there. So again, Sunbelt stuff is where we're seeing the biggest decreases in investor purchases. That actually should make you happy, because that would mean there's more for retail buyers. And also, if you want to invest and sort of go behind the scenes, there's more available for you as well too. Smallest decreases, Montgomery, Pennsylvania, Sacramento, Oakland. So maybe, well, I know in some of those locations, like maybe the Californias, they've already had a significant drop in value. So maybe that's why things are kind of bottoming out or leveling off there. Where the share of homes bought by investors increased the most. Well, the biggest decreases in, I guess you could say, the share. In Jacksonville, investors bought 19.6% of homes that sold, down 9.7% from earlier. Next came Atlanta and Charlotte. So again, it kind of works, they're decreasing the most and their share is going down. The biggest increase of shares by investors were Oakland, Sacramento, Montgomery County. So it's almost like, the smallest decreases where they're purchasing also, where they're purchasing more, most is now, it works on the share of the overall market as well too. So where investors bought the highest, lowest share of homes that sold, highest shares Miami, investors bought 30.5% of homes that sold. Next came San Diego and Anaheim. So these are more pricier locations, investors going in, doing probably some fix and flips and maneuvering and selling. All right. Lowest share, Providence, Rhode Island, Warren, Michigan, and Washington, D.C. So again, we're taking sunny places, seem to be moving. A lot of the northern or not so sunny, warm places, not so much these days. All right. Where investors own the highest, lowest share of listings. Highest share of listings, Miami, investors own 13.2% listings. San Diego and Detroit. Detroit slid in there too, because I know Detroit has had some good pricing, lower pricing lately, so that sort of makes sense. Lowest share, Providence, Montgomery County, Seattle. All right. Where investors had the highest, lowest capital gain percentages. Highest gains in Philadelphia. A typical home sold by investors sold for 113.6% more than the investor originally purchased it for. Next came Newark and then Warren. Lowest gains, San Fran, Sacramento, and Anaheim. So obviously the gains are still 30, 40 and 45, but not these, 3-digit 100 plus or almost 100 plus percent increases. Now, again, it's buy to sell. So the percent is interesting, right? So, you could maybe, your percent could be really good in Philadelphia, but your net dollar value could be better in San Francisco, right? Because of the price point of the home. So maybe you're 113% in Philadelphia netted you $25,000. So you're happy with your return on investment. But from a like a pure hardcore dollar value, if you bought a home for 1.2 million and sold for 1.6, if you're making whatever $200,000-$300,000 in the end, you're okay with a 30-40% return, but your dollar value is certainly bigger. So it's all relative to your location. Clearly, where investors were the most likely to sell at a loss: Detroit, San Francisco, and San Jose. Again, San Fran, San Jose, we all know what's going on there. Very, very highly overpriced homes. We have a lot of people who are leaving that area. A lot of companies are leaving that area, so maybe people are going, I've had enough with, and also we all know what goes on in those locations, so I don't have to get into it here. But there's a lot of, we'll call it social issues happening, and I guess people are getting tired. So California does have a mass exodus of people. I mean, a lot of states do, but that's the largest one. Least likely to sell a loss were West Palm, Florida, Anaheim, and Miami. So maybe something unique about Anaheim being, around the LA, Orange County area there. Obviously, West Palm and Miami, east coast of Florida, very hot. A lot of people coming from the north and northeast down in those locations. So there's nothing to worry about there. So it's just neat, though. But again, my point here is that before markets change, we see what I call, as I always say, the feet in the street, boots on the ground, the people who are actually doing the business on the line level. We don't see it in retail. We don't see it with MLS and real estate agents because that's a different market. But the investors see the signs, and it's all, again, why it makes so much sense is because investors are not emotional buyers, right? So if you're an emotional buyer as an investor, you probably need to check yourself at the door because that's not really going to lend you to making good decisions. But the point though is that the hedge funds, okay, it's all about yield, right? So if the numbers don't make sense, they're not going to buy that property. If it makes sense, they're going to buy it. So that's the difference. Same thing with other investors. It's like can we they're not doing it just for fun. They're doing it. They're not living in it for 30 years and looking for their dream home or their forever home. They're looking at it to make income. All right, income, build wealth, whatever you want to call it, however they want to categorize it. That's the situation we're in. So the investors see the signs first. They react first. They pull back first. So for me, when I see that and understand that, I know that the market's going down a certain way and we should continue to be prepared for things like that. So just keep that in mind. So the summary, I always mention here, guys, there are many opportunities, all right? The opportunities are not on the MLS and sitting there waiting for you to come by and pick them off or waiting for your agent to deliver them to you on a silver platter. It's not how this actually works, all right? We have an overabundance of agents right now, okay? Even in the county where I live, the active listings to, as a ratio to the amount of agents that are in the local real estate board, it's a 4-to-1 agent to listing ratio, okay? So, it's like there's way too many agents for what's out there. So, of course, you get an agent, find me a home. Well, 4 agents are all vying for the same one listing, right? So, or more. So that's why there's problems right now out in the marketplace. So multiple opportunities in multiple niches. No one's focusing on the niches. What are the niches? The stuff I showed you, I'll show you again. Will it be just like the 2008 crash? Well, I don't know. But, I think there's huge opportunity here. What are you waiting for? And I always say, don't miss out on this once-in-a-lifetime opportunity if you've never participated in real estate, or don't miss out on this second chance at a once-in-a-lifetime opportunity if you were participating or at least understand what was happening in the last housing crash, all right? What am I looking for personally in my business? Investor buyers, cash buyers who need single-family homes, okay, have access to those. Private funding partners for single-family purchases and other projects here in my area, okay? I need to recruit real estate agents. Why? Because the more people I have that I can train, the more distressed properties we can source and provide to you guys, all right? In the Tampa, Florida area and other parts of Florida, more joint venture partners. If you have a deal that you can't sell or don't know what to do with, connect with me and I can try to figure it out with you as well too. It's distress, probate, not paying the mortgage, whatever. I want you guys to bring distressed deals and we can work something out. All right, so that's the point I'm making here. And obviously with the program, so please reach out to me. I'll do a couple of videos now detailing what goes on in these things and showing you what we're actually really doing. So I want to say to you guys that I'm actually doing this business. All these things that I talk about: auction, bank owns, short sales, subject to, HOA, condo foreclosures, tax deeds, probate, zombie house, underinsured, surplus overages. We actually are involved in all this, right? We're looking at every deal from all of these perspectives and how we can maximize the opportunity. So again, who is this for? It's for people who just want to buy a home and not spend a huge dollar value for it. That is great. If you're an owner-occupant, this could help you. If you're a real estate investor, this could help you. I show you different ways or get you involved in the game. If you're a real estate agent, why are you not looking at these things? If you have clients that want to buy, why not do it for yourself? So that's the whole point of this. And I'm not going to go any longer, but if you want more information, reach out to me. Something also called novations. We have a different way of doing it, but that's the buzzword that's actually being poked around right now. So anyway, that is the scoop, guys. So once again, I appreciate the views, likes, and comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. And I'm going to try, again, I got some stuff I'm doing next week. I'll be out of town, but I'll try to do a couple of videos, but I'll be available by phone and email. So I'm traveling, and let's get people on that program, because I can show you exact examples of where we're buying properties at big discounts and having big spreads on them and neat opportunities that you're not going to believe. All right, guys, have a good weekend and a good week, and we'll hopefully talk to you sometime next week. See ya.